This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at Hurricane Hilary's record rain and impact on the insured.
Plus, is Disney set to surge past estimates as it works to keep the stream dream alive?
Stream dream, I like that. But first, 16 European companies are now on Bloomberg Intelligence's second half CEO pay tracker Watchlist. So it's basically a catalog of how CEO pay has changed versus what performance has actually done, and some misalignment there. Joining us now for more is Bloomberg Intelligence ESG analyst Andrius Tilvikas. Andrius, walk us through sort of the metrics that you guys use to track this.
So basically what we look at is trying to figure out the potential misalignment between executive pay and company performance. So firstly, what we do is look at the company's stock price performance and returns over the 3 years, and then compare it to the CEO pay growth over the same period. Afterwards, we look into the fundamentals. And since we are analyzing a broad-based index and a set of companies, we'll look at a few well-known and used metrics like EPS and sales growth and the estimate dividend payout.
So typically, Andreas, and for European companies, how's a typical compensation structure, incentive structure set up?
So typical incentive structure would be a fixed pay, a short-term bonus, and a long-term bonus, usually expressed in some type of equity element, either stocks or options.
So when you say scrutiny, then, so like if that's the differential that we're looking at, and you say scrutiny, what does that mean? Is that like regulators? Does it mean that shareholders push back?
It means shareholder pushback. So when shareholders identify the potential misalignment, the company comes at a heightened pressure and attention from shareholders asking questions why executive pay has increased by more than the reflective of the company performance. So if you take a simple example, we identify 12 companies, and one company's TRR over the last 3 years was minus 76%, while the compensation of CEO over that time increased almost twofold. So this creates a misaligned incentive between the CEO and the shareholder experience.
Has the compensation packages, have they changed in this era of ESG analysis? Have we seen any change in behavior, change in kind of what the boards are doing with their executives?
Yes, actually, one of my areas of interest of research has been executive compensation, and over the years, I have noticed the emerging trends in this area, and the ESG integration in executive compensation is one of the key themes that has been on the rise in recent years. So the idea is as simple as aligning CEO compensation and CEO incentives with those of broader stakeholder base. So integrating ESG metrics in order to motivate the executive making a strategic decisions that would be for betterment or improvement of wider stakeholder experience. So integration of ESG is one of the elements that we have seen as growing of the importance in the executive remuneration packages.
So what companies are we talking about?
So basically, when we looked at the list of Stoxx 600 European companies, we identified the 16 companies that are the laggards in that regard. So safe to say that the companies not on the list are so far doing an okay job.
So I see a couple names in here, like the material sector, the real estate sector, the consumer sector. What typically has caused some of these packages to be kind of misaligned, if you will?
I would say few things. In general, in executive compensation, it could be expected some volatility from year to year of in CEO pay. So one element would be a high bonus in 1 year, skewing the overall compensation package compared to the previous years. And then if that is not reflective in company performance and the company's fundamentals, this already causes a warning sign. As a simple example, if the company's CEO pay is increasing by 165%, while the company's EPS is dropping by 10%, this already indicates that there might be a misalignment in how the executive compensation package is structured.
Thanks a lot, Andrius. We really appreciate it. Andrius Tilvikas joining us, Bloomberg Intelligence ESG analyst.
Let's turn now to regional banks, where a shortfall in total loss absorbing capacity, the kids call it TLAC, could grow to about $200 billion. For more, we're joined by Bloomberg Intelligence senior financials credit analyst Arnold Kakuda. All right, what is this TLAC thing, and why is it important to banks and to investors?
Yes, so TLAC is basically a way to help these banks when they run into trouble. It'll impose less losses to the FDIC to kind of clean up the mess, right? And with the failures of SVB and First Republic, those situations did get resolved, but it left the FDIC with about, $20-30 billion holes, right, to the FDIC. And so if these banks had more debt that can be bailed in or written down in a time of crisis, then the ultimate losses to the FDIC and the system will be a lot less.
So how is this going to wind up evolving? Like, how much are the regional banks on the hook for? How much could they be on the hook for? How does that play out?
Yeah, so initially, given where things stand now, we estimate about $157 billion, but there's another regulation coming on board, Basel Endgame, which would increase risk-weighted assets, and that might push the total to about $200 billion. So kind of the missing piece right now was we're waiting on the details of what the regional bank debt requirements might be. And that should come, our regulatory expert, Nathan Dean, thinks as early as late September, but maybe more kind of, definitely by year end.
All right. So if I'm a bank and I realize, okay, the rules have changed. Now, oops, I don't have enough capital. Do I go out and issue equity? Do I do a bond offering? How do I plug that hole?
Yeah. So there are equity requirements that are rising as well, but the cheapest way for the bank to do this is to issue more senior holding company debt. And we have seen regional banks become more active in this space, although some have been on a bit of a pause given a lot of the rating actions that we've seen recently with S&P and Moody's. I think some of them might be waiting for some of the stuff to transpire. But, we have seen this week, we've had Charles Schwab. Last week we had PNC and Huntington. So they are coming to market to issue some of the senior holding company debt. But, once these rules are announced and we get a better sense of, what exactly the requirements may be and what the time frame that these guys have and some of this rating actions actually happen, we expect some of these other banks like U.S. Bancorp or Truist, we expect them to be more active issuing debt going forward. So
does this constrain what they also lend out?
So a lot of these, we have heard of, and seen banks' lending standards, tighten up as well. And then, it does impact a little bit, so the less aggressive you are with additional loans that you make, then you might need to issue less debt, right? Okay. So I think that is a part of the equation. But, the numbers that we're given, that we estimate, are looking at the snapshot of what they could potentially have to issue today if they don't do any sort of mitigation.
This is a really dumb question. Is this going to help and fix the problem, considering that each crisis we hit is a different crisis?
Oh, my goodness. Well,
I know. Okay, quickly, you have 30 seconds. No.
The regulators would like to think it'll help one aspect in terms of the loss to the FDIC. Those losses, things played out. These banks got acquired by more healthy JPMs, and other banks came in to acquire the healthy parts. But there was a big kind of hole in terms of the 20 to 30 billion deficits, right, at the FDIC. So at least from that perspective, the hole left the FDIC, and which that cost is borne by all banks, right? Mm-hmm. That should be less. So in terms of the cleanup process, it should be a little more smoother if there is a next crisis.
Fair enough. Of course there's going to be a next crisis. Arnold, thanks a lot. We really appreciate it. Arnold Kakuda, Senior Financials Credit Analyst for Bloomberg Intelligence.
Coming up on the program, we'll take a look at how Disney is keeping the stream dream alive.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Disney's focus on reaching streaming profitability on a combination of price increases and lower spending could bring $2.5 billion in fiscal 2025 operating income. For more, we're joined by Bloomberg Intelligence senior media analyst Geetha Ranganathan. Geetha, I guess that's kind of one of the key issues, not just for Disney, but for all the big media companies, is how and when are they going to get their streaming businesses profitable? What's the key for Disney?
Yeah, absolutely, Paul. So, the narrative definitely has now changed in the media industry where, this crazy chase for, streaming subscribers is kind of over, and now everybody is focused on profitability, is focused on getting to a cash flow break even and, kind of understanding the long-term earnings potential of the model. In terms of Disney, obviously they got to a very sizable subscriber base very, very quickly. They have about 150 million Disney Plus subscribers. They've achieved that in a very short span of under 4 years. But as you know, the market is now really focused on profitability. They lost about $4 billion last year, but they are really cost-cutting. They are laser-focused now on kind of trimming those losses. So we think they'll get to so they have said that they'll actually get to break-even profitability by fiscal 2024. That's, next year. But then the question is what happens after that? And we think that they can actually get to sizable profits, once they have all of their operating levers in place.
Okay, so what are those operating levers? Because short term, we could say, okay, the Hollywood writer strike has helped because they're not paying actors or writers, right? There is that. But but putting that aside, what are the longer term structural things that are going to help?
So one of the things that is going to help, and this is something that they're actually going to implement in a few months' time, is price increases. And so they're really going to test the market to see, how sticky that consumer is. I would argue that Disney actually has a lot of leverage when it comes to price increases, because remember, when they introduced their product, it was actually at a very, very competitive price point. So they were pricing Disney Plus at around $7 when everybody else in the industry was charging, Netflix was charging almost $15. HBO Max was charging $15. So they kind of left themselves, I think, a lot of room in terms of price increases, and they already had implemented one late last year. They're going to be doing another one where they're going to be hiking prices on their ad-free service by about 30%. So that's obviously a big initiative, and I think they're going to do that at a pretty regular cadence. The other initiatives that they have is they've also spoken about a password crackdown. This is something that Bob Iger brought up in the most recent call. They haven't necessarily given us numbers, but we know that from Netflix's disclosure that almost 100 million Netflix subscribers, that was the number that they gave, are sharing passwords. And so we think that a substantial number of Disney Plus subscribers also might be, sharing passwords. And so they're looking to monetize that starting next year. And then, of course, the really big initiative for Disney, and I think this is where they have a huge leg up on Netflix and really anybody else in the industry, is in terms of their ad-based tier. So they've already made substantial efforts. They said they have about 3.5 million subscribers on their ad-based tier. But this really will become a significant driver of not just new subscribers, but I think also of revenue for Disney, because they already have a lot of the infrastructure in place. Remember, this is something that was completely new for Netflix, but Disney already has a huge ad business, not only with its linear TV networks, but also with Hulu.
So, Geetha, one of the big levers here to getting to profitability is, of course, their costs, their programming costs. And you've got a great chart in your research note. I guess the bad news is for Disney, they're at the top of the chart with about $30.5 billion. Now they cut that to $27 billion. I guess that's the good news, but that's still like the biggest amongst the peers. Just for a point of reference in your research note, Netflix's programming budget is $15 billion. So just help us square away, what's Disney spending all that money on?
Of that $30 billion content budget, we have to remember that they are the owner of ESPN. And ESPN spends roughly about $10 billion or so per year on sports rights, and those will only go up. I mean, think about the new NBA deal. Of course, they're going to have to spend more. Any of these new renewals that are coming up, whether it's UFC, whether they want to go for WWE rights, all of that is going to cost them more money. So that's something they're going to have to be really disciplined on. And in terms of films, I mean, Disney is one of the studios that always kind of takes these big swings, has these huge blockbusters. They have a film budget that's easily, $2 to $3 to $5 billion in any given year. Bob Iger has come out and said that, they are going to be taking a hard look at all of the different projects. Cost cutting is definitely front and center. They've outlined actually about $3 billion in, content cost cuts. So it's going to be interesting to see how that plays out. But I think mainly they're really going to be focusing on their entertainment programming budgets.
So I was going to say that they don't have any reality TV, right? And isn't that like low-hanging fruit?
It is, and that's one area that they can really get into. They've always prided themselves on being the best in terms of scripted programming, in terms of dramas. So we'll have to see how they kind of look to bring down costs. I mean, reality TV is a great point. The other thing that they can really look to do is kind of take a page out of the Netflix playbook and really go after more local productions, more international or overseas productions, which are typically a fraction of the cost when compared to Hollywood. All
right, Geetha, let's stick with Disney, but pivot away from the streaming business and talk about ESPN. What is the company going to do with ESPN? Once the cash cow of the company, but now they're looking to possibly unload it. And Dan Ives, an analyst at Wedbush Securities, he was out with a note a couple of weeks ago that got a lot of coverage that he thinks Apple could either buy it or partner with it or something like that. What do you think Disney wants to do with ESPN?
Yeah, I'm not necessarily sure, Paul, that they actually want to get rid of it. I think they still view this as, kind of integral to the Disney brand. It, as you said, it does bring in about, $3.5–4 billion in EBITDA every year. And they've already, started kind of the process in terms of monetizing the brand. So one of the things that they've done over, the past few weeks is kind of inked this deal with Penn, where they're kind of licensing the brand name, the ESPN brand name, for a Penn sports book. So I think they're kind of looking at different ways to really, kind of leverage that brand name. I don't necessarily think, again, that they want to sell it completely. They're probably looking for partnership. There's been some other chatter in the news suggesting that maybe, a telecom operator like a Verizon would want to come and partner with ESPN, kind of distribute the streaming service when it actually takes off. So again, a little bit of a wait and watch still.
But in terms of the Penn deal, do you like that? Because it's sort of just like gaming without the risk, right? Or gambling without the risk?
It's a win-win, I think, for Disney. I mean, I think the only, reservation that's kind of been there is, Disney always has kind of had this very family-friendly, kind of squeaky clean image. So, that has kind of always been the holdup, the hesitation to go after gambling. But I think Bob Iger sees that there is a lot of opportunity, there's a lot of potential, and you're absolutely right. This was, a low-risk, high-reward kind of a situation.
Hey, Keith, how concerned are the Disney people about their film business, their movie business, which was just so rock solid with all the franchises that they do own? How concerned are they about it?
I mean, they obviously, Disney has a fantastic track record, Paul, but the past few months or even the past year actually has really not gone well at all. I mean, we've seen a whole string of movies not performing. We're seeing a lot of kind of franchise fatigue. And I think Bob Iger kind of realizes that, and he's kind of sitting down. We've seen some other movies, like movies with fresh IP that have performed extremely well. So obviously it is a Disney-specific problem. I think they recognize that. It's going to be interesting to see how he goes about kind of changing things up.
Yeah, I mean, can he make a Barbie movie?
Yeah, exactly.
I mean, I'm kind of joking, but not, because
I know
people are really kind of, Avengered out. We're Star Wars out at this point. Like,
they've
we'll go
pushed back.
see them, but
And they've pushed back the releases, as Geetha well knows, for a number, because I think in part due to that. So Geetha's right; they're going to have to kind of rethink it a little bit. I mean, they still have the best franchises, the best characters. All right, Geetha, thank you so much for joining us. Our thanks to Bloomberg Intelligence senior media analyst Geetha Ranganathan.
All right, coming up on the program, hurricanes and wildfires. Just how much are they costing insurers?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
There have been a lot of natural disasters that have happened very recently. You had the wildfires in Hawaii, you had Hurricane Hilary hitting California, then there was an earthquake, but we're kind of used to those, and of course the Canadian wildfires as well. How much does all of this actually wind up costing? How much does a storm like that rack up in losses? How do insurers deal with that? So we're joined now by Matt Palazola. He is Bloomberg Intelligence Senior P&C Insurance Analyst. Let's go right to Hurricane Hilary. How much does that wind up costing the guys who insure the houses, who insure the cars, who insure businesses?
So it's interesting, Alex. It probably won't cost the insurers a lot. What is going to happen is we look at flooding that happened earlier in the year, in the winter, and economic losses there were about $5 to $7 billion. Only 10 to 20% of that was insured, so the insured losses were about $500 million to $1 billion. It's very early to look at this, but I think we're looking at things in a similar ballpark. So there's going to be a lot of uninsured homes in there.
I'm shocked because you told me this in an earlier discussion. Most people don't have flood insurance.
Most people do not have flood insurance. About 2% of the people in California have flood insurance. Nationwide, about 30% of the people in flood-prone regions have flood insurance.
So it's just location?
It's
like they're not used to having floods, therefore they have earthquake insurance but not flood insurance?
So if you're in a flood zone and you have a mortgage, you need to have flood insurance. But a lot of people, the flood zone maps are very old. They were written in the 1960s and 70s. So they're not reflective of the actual flood risk. So a lot of people in flood-prone regions don't have to have it, and it's expensive, so they just don't buy it.
All right. So is it shaping up to be an average year for insurable losses from all of these issues? Above average, less than average? Where are we so far?
About halfway through, we're about a little above average. And we haven't had a real big event, believe it or not. So we've had these kind of crazy things, but nothing has been dramatic. Last year, Hurricane Ian was like $50 billion of insured losses. We might be at that level just now halfway. So if we had another Ian-sized event, it could be a record year.
So how is this going to wind up affecting the insurance industry in that they're going to have to come up with different kind of policies, or do the premiums wind up going up? Because at some point somebody pays. So if they're only like on the hook for 10% of the $5 to $7 billion you're talking about, someone's paying for that.
So, Alex, you're hitting on a great point, right? There's a protection gap. So there are things that are not insured. A lot of this flood risk is going to go uninsured. Some of it's going to fall on the federal government, which insures a lot of the flood risk. The insurance industry has an appetite for some of these things, but it's limited. So I don't think you're going to see new policies. I think a silver lining of all of these crazy events is it might raise awareness, so people might understand that they need the existing products. I don't think there's going to be new products, but there could be an increase in demand.
Well, having spoken to you over the years and reading your research, what comes back to me a lot is, take Florida, for example. Taxpayers insure Florida, don't they?
Yeah, so
like New York taxpayers insure Florida residents.
Well, to some degree. So what's happening in states like Florida and California, there's a state fund. So if you can't get insurance from a private insurance company, you get it from the state fund.
And the reason there's a state fund is insurance companies won't go into those states. And the reason they won't go into those states is because they're always having natural disasters, because they build all these homes either right on the ocean or on a cliff in California. That'll be
you're right next to a fire. Yes. So that's what's happening. Part of it, though, is it's catastrophe prone, but also in these states, particularly Florida and California, the regulatory body is not great. So that scares the insurers away a little bit. a lot of fraud in Florida.
No.
Scares. Yeah, if you can believe it, there's a lot of insurance fraud in Florida. The state has worked on it, and we're waiting to see if that stuff pans out. But that's also keeping insurers away. So you've got three big things keeping insurers away, which leads to these state funds. So they're run by the state, not the federal government. So it's not necessarily New York. In terms of flood, that is a federal program. So you might be paying for someone else's flood. But like we were saying, the flood take-up rates are not high anyway.
What could reinsurers help the insurers?
Now we're talking. This is my favorite part.
Get into Florida,
Paul's
for example?
ears perked up. So the reinsurers were actually the reason that insurers were leaving Florida. So reinsurance was becoming too expensive. The reinsurers were the first ones to put their feet down and say, look, we can deal with natural disasters. We can't deal with this rampant fraud. So they put their foot down. And then when the primary insurers couldn't get reinsurance, then they couldn't operate. So you had a few of them going insolvent. So the reinsurers could technically help, but they just won't. I mean, the prices for reinsurance have been going up dramatically. So reinsurance capacity is coming back nationwide. So that will be a positive factor over time.
Boy, it's just we're towards the end of August here, and we really haven't had a big hurricane. Like Florida, Texas. I know.
Bite your tongue, Paul. There was a lot going on in the Atlantic. Well, we had for the first time in maybe 30 years a tropical storm hitting California.
West Coast. Yeah.
So we made up for it with the lack of activity in the Atlantic. There was a bunch of things going on. There's some stuff cooking there now. So we're not in the peak of hurricane season yet. It's coming.
Oh, is it? All right.
Well, I think also my issue is that as the climate changes, certain things develop that we're not prepped for. Even something basic like the Maui wildfires, right? Like just the fact that things are really dry and then maybe there's a power line that didn't work so well and toppled over. I'm not saying that that's definitive. I'm just saying, what if? How hard is it to insure against things that are changing so fast that we just don't know?
So great point. I think it is difficult, right? I read a statistic that over the past century, wildfires in Hawaii have increased 400%. And part of that, though, is a human problem where apparently people brought a non-native species of grass into Hawaii,
really?
which is really prone to fire. So it's climate change, it's human intervention. Two other things driving the uncertainty for insurance companies are property values, which have been going up dramatically over time, and the density, like Paul, where you were talking about. People are living in these catastrophe-prone regions. I think the industry is well suited. They can deal with the risk. I think it's these things, the unknown unknowns are kind of the issue, where kind of something like a cyber comes into play there. But otherwise, the known unknowns they're good at.
All right, Matt, really, really interesting. I didn't know that about the grass. That's going to stay with me for a while. Matt Palazola, Bloomberg Intelligence Senior P&C Insurance Analyst. Thanks a lot.
Let's turn now to power, where a renewable energy switch is proving positive for copper. For more, let's welcome Bloomberg Intelligence metals and mining analyst Grant Sporre. All right, Grant, tell us what this move towards renewable energy means for copper.
Copper has a number of competing demand forces that are sort of pushing and pulling it. On the negative side, which is obviously garnering a lot of the headlines at the moment, is China's sort of maturing urbanization and industrialization trend, which I guess is playing out through the country's property market malaise. But on the flip side, and this is where the real positive comes in, is renewables and the EV transition. So both of those probably have the heft to overcome the negatives that we're seeing in China at the moment. Maybe not every year, and there may be periods where there is some temporary weakness, but certainly over the decade, renewables and particularly the power build-out, where both solar and wind are much more copper intensive than your regular power build-out, could really sort of support copper demand at or maybe even slightly above trend.
Before we get to the pricing of it, give me some perspective as to how much we are undersupplied longer term when it comes to copper in terms of the demand usage and the actual supply.
There's a number of ways of slicing and dicing this, and it depends on a number of moving parts. But to put it simply, the copper mining industry, certainly on our calculations, has to deliver another 2.5 million tons of mine supply by the end of the decade. Otherwise, we are going to see some shortages. And I guess the point here is they've got to get going quite soon to getting those approved because of the lag between when you actually start something and deliver it. So that's the best way that I can put it. There are obviously other forces that can come into play, such as recycling, etc. But that's the key number we really look at. It's about 2.5 million tons if the industry doesn't deliver.
Where is China? Just give us a sense of where China is in the supply and demand of global copper.
So, China is just over 50% of global copper demand. Arguably, that proportion is going to shrink slightly over the next decade because you've got the sort of reshoring of manufacturing in many developed markets, such as the U.S. You've got India, which is growing at a rapid rate, and some of the smaller Southeast Asian countries. So that might, over the decade, go to around 45%. But nevertheless, China's still going to be very, very dominant. So that's on the demand side. On the supply side, and we take it back to basics, i.e. mining, China is it might be the third biggest copper producer globally behind Chile and Peru, but it is relatively small. It only accounts for about 2 to 2.5 million tons out of a market of around 26 million tons. So the imbalance is extreme. It's still got to import a lot of copper going forward.
But here's what I find confusing is that the go-forward outlook can be so bullish, but I don't feel like that's reflected in the price. You're looking at, $8,300 for copper over at the LME. And I'm wondering what the biggest disconnect is. Is it China today versus the China and the globe in 30 years kind of thing?
Well, yeah, that's the real sort of conundrum in copper at the moment. At the moment, the market doesn't look particularly tight. And in fact, it's probably going to be slightly, and only slightly oversupplied for the next couple of years. Because what we're seeing is, all those mines that were struggling to get going during the COVID period are now suddenly going to deliver. They're on the cusp of delivering, and the outlook is starting to improve there. And that's coming just at the time when it looks like China is going to be a little bit slower in terms of its demand. So that gives us a slightly oversupplied market. And we've got this for a couple of years. But then, that sort of wave of new supply quickly sort of fades or peters out. And now we're back in the sort of perpetual deficit horizon. So unfortunately for a lot of investors, it looks like, well, maybe it's a jam tomorrow story. At the moment, it's not looking particularly good. So that's sentiment is playing, I think, quite a large negative weight on copper at the moment.
Hey, Grant, it is now time for the dumb question of the day, and I am just the person to ask it. Is there enough copper out there? Like you mentioned Chile and Peru. Is this a rare mineral? Is this something we have to worry about running out of?
So, no. There are plenty of reserves and resources of copper around, in the Earth's crust. So it's not as though we're going to run out. Every incremental ton that you want to try and extract is going to cost you more.
Right.
And it's going to come at a price. So, I think it goes back to Alex's question. Is 8,300 a good enough price to incentivize new supply? Look, it's probably on the cusp. If it were to slip down below sort of 7,500, then we're getting to a price which is probably not quite attractive enough to incentivize the miners to go and build new mines.
Right. So it's like we have it, but what price are we going to get at where we can get it? And that's where I feel like the short-term dynamics come into play, because the signal for the copper price right now, is it good enough for miners to want to dump money into an underground brownfield, greenfield pit?
Well, I must say, look, the mining companies are sort of have transitioned to a more pro-growth stance. So it's, they've moved from, look, we're just going to pay out dividends and we're not going to grow at all. And they are starting to grow. And we've seen that with some, smaller, acquisitions, some larger attempts at acquisitions. And, project approvals are coming. I guess the question is, are they coming fast enough? So I think the miners are sort of taking a medium, longer-term view and saying, we believe in the fundamentals of the copper market, and we're willing to, wear a few, perhaps, a couple of leaner years in the very near future.
Grant, always good to get your perspective. Thanks so much, Grant Sporre. He's metals and mining analyst for Bloomberg Intelligence.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.